Hey, Paul DeLaury here. So a client recently asked me when they need to file a gift tax return. And the question really was, listen, is the IRS really going to be able to track what I spent money on, 10 years in the future, 20, 30 years in the future, something like that? Well, so here's the reality. Um, the IRS is shockingly able to discover things like that. I'm not sure what kind of software they use or whatever, but I wouldn't assume that the IRS will just never find out about it. So the rule is this. You have an annual gift tax exclusion, $13, $14, $15,000, whatever it is in a given year. And if what you give per person is under that, then you're good. Then you don't need to file a gift tax return. But technically, anything over that, you're supposed to report. And here's the issue. Let's just say, you're going to roll the dice and see what happens. Well, okay, but you might actually be leaving a mess for your kids, especially if you're in a higher net worth bracket where there might be an estate tax return due, where this might actually become an issue. Now, okay, currently that's, $12+ million. That's coming down to roughly $5 million adjusted for inflation, blah, blah, blah. And that's probably we don't know exactly what it's going to be in a couple years, but it's currently set to come down to around $5 million. So if your net worth is over $5 million, let's say, I would really be concerned about this. And the issue is this. When you pass away, if your net worth is, let's say, $5 million and there's a estate tax return due at the time, someone in your family, whoever's in charge, the personal representative of your estate, for example, needs to file this estate tax return. And on that, they need to report prior gifts because you have a applicable exclusion. It's called applicable exclusion, and that's basically it's for any gifts that you've given during your lifetime, plus your net worth, and then you have this applicable exclusion. So if you've the total that you've given plus your net worth is over this exclusion, then there's a gift tax due. There's variations of it. The highest percentage though is 40%, so kind of a big number. The real issue is this: is your family going to be able to find a attorney, CPA, someone who does gift tax returns and estate tax returns, who is going to feel comfortable reporting to the IRS that, for example, no gifts were made, when you tell the person, well, there were some, but dad just didn't report it. He just figured the IRS wouldn't find out. Well, that puts the attorney or CPA in kind of a professional quandary, because their license is on the line. They can actually be fined and gone after by the IRS. So they're probably not going to be comfortable. A good professional advisor, which is what you want to be working with, is not going to feel comfortable lying to the IRS, essentially. And I was just talking to another attorney who does gift tax returns. I do gift tax returns and so on. But I was talking to this other older fellow here locally, and he said he had to go back, I guess, like decades, and report prior gifts. So the issue with that is, like, how do you value these prior gifts from years and years and years ago, to the standard that's required to report to the IRS. So that's kind of the issue. It's just simpler if you just do it now, you know, when it's current. You can get some kind of evaluation to report to the IRS. Everything's done. It doesn't cost that much money. So anyway, that's the answer. File gift tax returns if it's over the annual exclusion amount. And by the way, if you like this video, please subscribe and like it. And if you have any questions about gift tax returns or estate tax returns, we do them at my law firm. So yeah, just get in touch with us. Our phone number, there's going to be contact phone number and email and stuff in the notes below. Okay, have a great day.